What's going on, you guys? It's Cody Steck. Today we're going to be talking about whether or not you should refinance one of your rental properties. In the past here on the channel, we've talked about knowing when it is a good decision to either buy a real estate property or make a refinance on that same property. One of the things that you need to look out for is how long is it going to take you to get your money back. For myself and for a lot of other real estate investors, looking at the cash on cash return is probably the biggest indicator of knowing whether or not you should make a decision, right? When it comes to repairs on a property, you need to know how much that's going to give you in return, and then how much it's going to cost you to actually make that repair. So if a repair is going to cost you $1,000 and it's going to get you an extra $50 a month in rent, that means that over the next year you're going to get $600 for rent, and it only cost you $1,000, so that's over a 50% return. I think it's 60% return, right? That's a very good cash on cash return. So looking at that same exact formula, we're going to use that same instance to know whether or not doing a refinance on a property is actually a good idea. So the thing I want to talk about here today is a specific property that I'm looking at refinancing. This is a deal that I bought about 2.5 years ago. I went in, I fixed it up, did the rehab, got a tenant placed in there, and then was able to refinance it up to 90% of the total value after I put the work into it. So I was able to pull out all of my money on this one particular deal, and now that deal produces $700 a month in gross cash flow. So this actually turned out to be one of the best deals that I've ever done because I had no money into it by the time it was all said and done. However, things have changed now, and I actually want to be able to refinance it again to drop the payment even lower. Interest rates have dropped again, and now I've got at least 80% equity because the value of the home has gone up, and I've paid down the loan a little bit as well. So we're going to be breaking down the numbers of what I currently have as well as what I will have going forward. So for the sake of the video, I'm going to throw the numbers right up here on the screen so that you can follow along with me as we go through this. So the original loan that I had was $220,000. This was at a 4.625% interest rate. This gave me a total payment of $1,133 per month just for the mortgage. This isn't including taxes or insurance. Out of that payment that I was making every month, or the tenants were making those payments, $299 was going towards principal and $834 was going towards interest. So that's what I already had on the property. Now, what I want to look at here is the new loan that I'm actually looking at getting. So this new loan is $216,000. That's what I paid the loan balance down to, and that also actually comes out to exactly 80% loan to value. And this is going to be at a 3.5% interest rate. So I'm dropping my interest rate by over 1.1%. This is going to give me a new payment for just the mortgage of $969.94, of which $340 will go to principal and $630 will go towards interest. What does this payment actually look like? It's going to be $163.74 of savings through the payment drop itself. And I'm going to be paying down the loan by $40 a month extra on the principal. And that number is going to scale up ever so slightly as we get further and further into the loan. So just on the cash flow alone, this is going to increase my cash flow by over $1,965, and it's going to give me an additional $480 of pay down every single year. So again, that's something that the tenant is paying for, and I'm getting that additional cash flow. So overall, this is almost $2,500 a year in additional benefit that I get from going through this refinance. The total cost to do this refinance is going to be about $5,700. This includes the loan fees, the origination, the appraisal, the closing fees, all of that stuff that I'm going to have to pay for. So looking at the fact that my cash flow is actually going to increase by $1,965 per year, and it's only going to cost me $5,700 to get that, that means that I'm getting a 34.5% cash on cash return, which means that I'll get my payback in under 3 years. My payback for what I'm looking for, I want it to be 5 years maximum. If I can get under 4, I'm super happy. So this one being under 3 years to get all of my money back, I'm super excited for that. Also, this is a property that I plan to hold for the long term. So I plan to hold this for at least 5, 10, maybe even 15 or 20 years because the cash flow is so good. It makes for a fantastic rental, and unless the value really shoots up very high in the next 10 to 15 years, I don't really anticipate selling this property. I'd rather have the cash flow and continue to build capital elsewhere to then put into bigger deals. So eventually I think I'll probably sell it off 15, 20 years when I need the equity and I don't want to deal with these smaller properties. But for now, I'm going to take that cash flow, right? So $2,000 a year extra in just cash flow plus that faster pay down on the actual mortgage, that's going to be a huge benefit for me. And so this is how I'm calculating my numbers. Jumping back to the actual total return, this isn't accounting for any changes in tax benefits or anything like that. This is just kind of the cash flow and the pay down on the property. property, I'm gonna get a total return of 42.9%. This is absolutely phenomenal. This means that in just 2.5 years, I'm gonna have my total investment come back to me. A little bit is gonna be in the form of principal paydown, which is not actually going to be realized because I'm not selling the property, but most of it, 80 to 85%, I think, is actually gonna be in the form of cash flow, which I can use to pay down the loan further. I can use it for investment purposes on other properties. I can invest it in stocks. I can invest it, in my own personal expenses. I can do whatever I want with that extra cash flow. So that's really one of the cool things about that. If you're considering making a refinance on one of your own properties, this is something you definitely need to take into account. How much is it going to cost and what benefit are you going to get out of it? Make sure to look at the interest rate, make sure to look at the cash flow as well, and figure out how long it's going to take you to actually get that money back for what you're putting into it. And so with all that being said, guys, this was just a quick overview of how you can estimate whether or not you should refinance a rental property. If you enjoyed this content, give me a thumbs up here on the video. Don't forget to subscribe if you want to learn more about money, stocks, and real estate here on the channel. I love talking about all things. I try to put out at least a couple of new videos every single week. And with that being said, I'll catch you guys in the next one.